Hi, everybody. Good afternoon. Welcome to today's webinar. We are recording, and this is live on June 22nd, 2023. My name is Brooke Warrington. I am the new Training and Development Specialist here at the Native Learning Center. We're so happy that you could join us today. Today's webinar topic is practicing homeownership resilience. Before we get started, I do want to familiarize you with some of the features available and how the environment works. So if you look at the top of your screen, you'll see an icon of either a person with their hand raised or just a hand. With that icon, you're going to be able to either raise your hand, agree, disagree, or you could step away too. Now your screen should look similar to this graphic here. To the bottom left, you'll see a box that says Files. So here you're going to find today's presentation. Feel free to download a copy for yourself if you'd like. Simply click the item you want to download and then click that arrow pointing downwards, and you'll be prompted to save or print the materials based on your device's permissions. The second box that states Web Links To, that has today's survey as well as some other links that are found throughout the presentation. Lastly, to the right of the screen, we have a chat box available. This is how you're going to communicate with the instructor today or with the NLC staff. So if you have any questions during the presentation, please feel free to interact by using the chat box. You can just type your message and hit enter or click that up arrow icon to submit it. And we do encourage class participation, so feel free to write in those questions or comments. Any tech support issues should also be submitted there as well. All right, and this is the link for today's survey. We are going to send that a little bit later, so we'll come back to that. All right, so it's with great pleasure. I'm going to go ahead and introduce today's webinar instructor, Marie Bonville, and I'm going to pass it over to you, Marie. Thank you so much, everybody.
Alrighty, sorry about that. Took me a little bit to get the second screen up. Thank you everybody for attending today. Thank you, Brooke, for that introduction. I really do appreciate it. We got a lot to talk about today, so we're going to go ahead and jump right into it. Hopefully everybody can see my screen as I share today's presentation. So let's see here. We're going to be talking about practicing homeownership resilience. What does that look like? Let's talk about that. A little bit about myself. I started my career with the Seminole Tribe of Florida. I won't tell you when, just that I worked within their education department for several years in different roles. And then eventually I moved to the Native Learning Center, where I really found my home in working with Native communities across the country to increase homeownership. I mean, that has really been my life's work. It's what I love to do. And I do it in so many different ways. As owner of Sunlight Armor Homes, which is a residential construction and remodeling company, my husband is a general contractor. And then also we have a realty group. You know, when I do Sunlight Armor trainings, just to kind of give you a background, you know, who doesn't like sunlight in their home? I mean, when a light fills a room, it does make a difference and it makes you feel welcomed. And so that was the first step. But then Armor, we decided with the European version of that, right? So you might think it means love, but Armor itself, it's strength, it's quality, durability. It's what you want in a home. And so for us, you know, when I made the decision to, my husband and I made the decision to call ourselves Sunlight Armor Homes, it's because I know how much homeownership means. And in Native communities, we've got so many different layers to how homeownership is attained that it can sometimes feel like an uphill battle, but it's been so exciting to know all the new things that are coming to homeownership, to see the increases that we've had, to be in a place where we're talking about foreclosure prevention, right? Because you first have to have someone in a home for us to be in this place and space to be able to talk about how to keep them there. Right. So we have come a long way. I'm excited to be here with you. And I'm thankful to the Native Learning Center for bringing me back. So again, talking about homeownership education, that's typically pre-purchase, right? Our first-time home buyers are wide-eyed and they don't know a whole lot about the process, and it's exciting to see them through. But I do think that we can make an effort to connect with our current homeowners, to give them guidance, especially after the pandemic. There was a lot of money, if you received half funds or others to assist current current homeowners in the process. Maybe they were in the middle of a payment deferral or forbearance, whatever their circumstances were. I feel like it would be so helpful for us to start as practitioners to include this in the narrative, right? To constantly find a way to connect with our current homeowners, especially when it comes to crisis budgeting, refinance options. Like, what do those things mean? We'll see that those that understood what refinance means actually did much better during the pandemic for themselves in the long run. So I'll show you what that looks like. Our objectives are simple. We're going to talk about budgeting for homeowners when they're in a crisis mindset, or we're going to talk about evaluating refinance options if that's a good place and space for our clients, and then also mortgage payment deferral, that whole process of forbearance and loss mitigation. Most of our clients just assume they're going to be able to make their mortgage payments and never think twice about what could happen. So we want to prepare them for that. If you've been with me in other trainings this month, then this is what if you haven't been with me, I should say, then this is what you've missed. We talked about housing as a market. We talked about the home buying process, right? Both on and off reservation. We talked about maintaining that investment, right? You got to know when to use the right professionals, whether that's a handyman versus a general contractor. And then, of course, Section 184, which has been the main vehicle to home ownership up until this point for most Native communities on trust lands. So a little bit about the housing market. In 2008, we all know that to be the Great Recession. Monopoly is that game of chance. It's the game of buying and selling real estate for profit, right? Once someone lands on your property, you get some rent money, right? And so I know even with my own kids, I'm always amazed at how caught up in that process they can get. And so in 2008, I will say that how I ended up in real estate and in the world of homeownership education and affordability and all of that really comes from this area. I don't know if I mentioned it in any of the last trainings, but I will share it with you. I purchased a home in August of 2007. And officially, according to economists, the Great Recession, the housing market tanked March 2008. So I was in the middle of all of that confusion in terms of how to address, who do I connect with? What do I do? What do I say? Who do I talk to? When all of the banks were kind of in limbo and didn't have guidance before the government had gotten involved, it was a very confusing time. And that's because I didn't have basic homeownership education. I didn't know what I was signing up for, and I didn't understand what an ARM was. I didn't understand these things. And so I'm thankful that really and truly 2008 is why I do what I do now. So I don't regret it, and I don't wish that on anyone else, of course, but I do think that it's made me who I am today. And so with that, I say education is really the key to our future home buyers, right? What they experience is really something we can help navigate as far as, it just being too much information. There's so much information out there. In 2008, we didn't have much to go off of, and now we may have too much, right? And by way of technology and tools and things like that. So as practitioners, I think we can do a great job of giving them the knowledge that they need to be successful. June is National Homeownership Month. It's probably why I've been asked to be on so often this month. And so I do have a couple announcements. I think they're really important. And so if you've heard it already, I apologize, but I do think it's important. The first is our Native American Direct Loan. So that is where the VA is the actual loan provider for our Native American veterans to purchase homes on trust land. Now that NADL loan product, it's typically been market rate, right? So whatever's going on in the market as of the last month, they have announced that it's going to be at 2.5%. And that is in an effort, and this is the interest rate. This is an effort to make the homes more affordable for our Native American veterans. That's huge. So as of right now, that interest rate will remain at 2.5% for over the next 2 years. I don't know if it's going to change. The group I work with, the South Dakota Native Homeownership Coalition, and Senator Round's office is working to make this a permanent fixture to the loan. But as of right now, for sure, this is a benefit to our Native veterans, and one I hope that continues to spread as far as the word is concerned. The only other thing I will mention is that if a veteran currently has an NADL loan, they can also refinance this loan as well. And the unique thing about the VA loan and the NADL is that it's 100% financing. So there's already a benefit for their service in that it's 100% loan and there is no down payment. However, when you go from 7%, which is where the market rate is now, to 2.5%, you can imagine what space that'll leave for an affordable mortgage payment. So the next thing is Section 184. That's the main vehicle to increase capacity for communities, for tribes to provide housing, homeownership housing, on the reservation. As of July 1st this year, so in the next 2 weeks, if you have a home close after that, the PMI will be reduced from 0.25% to 0%. And the day before yesterday, I broke it down in numbers and showed just what that looks like, on a $300,000 house. That's a savings. And so it's helpful. Also, the loan guarantee fee will be reduced from 1.5. Now, the loan guarantee fee is a one-time fee, but it can't be rolled into the in this particular case, going from 1.5% to 1% is good. And now the homeowner may not have to roll that into the mortgage itself. And of course, I provided the link so you can learn more about that. And then lastly, as of June 7th, 2023, so just the other day, Freddie Mac introduced a Native American home loan product. So competition is good, folks. Thinking about the challenges that we face and the access to capital issues that we face, Freddie Mac is looking at that and saying, well, why don't we work with the Native CDFIs to increase capacity and maybe make them direct lenders? So there's a lot to this that we are excited about. There's a lot of details to come. But as of right now, the program aims to increase affordability, especially in rural and tribal lands and rural locations where majority of our folks we serve live. So that's a good thing. But we still have more work to do. We're behind the national average when it comes to homeownership rates. 42% of Native American households are underbanked, and the national average is 70%. So it just goes to show you that there's still a lot of folks that are being taken advantage of when they have to go to check cashing stores or payday loans, which are predatory in nature. So how do we, continue to build wealth, save money and build wealth? What can we do? Well, we can start with homeownership resilience, because these individuals already have an asset that we need to protect, that they may not have ever had anyone in their life to show them, the way. So this is a good thing. It's funny because in 2020, maybe 2021, I was supposed to do a presentation. They wanted me to do something on foreclosure. And she said, but we don't want you to use the word foreclosure, which I thought was crazy. I'm like, how am I supposed to do a training on foreclosure without talking about the word foreclosure? And so I looked up the word resilience. The definition of resilience is your ability or the ability to absorb shock, right? And so I thought, well, that makes total sense. It's not that we want to talk about foreclosure. We want to talk about how do we protect our families from shock, the shock of loss of income, right? Of losing a job, the shock of a family member or a friend that is in need, and now maybe they're sick or something along those lines. So meeting financial obligations is that first step. Prioritizing homeownership expenses and repairs, that's really what we should be looking at. And so I'd say use resiliency or resilience instead of foreclosure prevention, or those types of terms, because sometimes that can be off-putting for our homeowners. Understanding refinancing options for sure. This could be a cost saving to our families, and if you know how to work the system, it would be to your benefit. We'll talk about home equity line of credit a little bit, just because banks are businesses and businesses sell products. So if you're a homeowner, you're getting this stuff in your mail, right? You don't know what it means necessarily, but you're getting solicitations for it. So we need to protect them from that as well. It may not be the right time for these instruments, so we need to know more about them. And then lastly, understanding the repayment process, right? Communicating with what's a loan servicer. I mean, most people, they get their loan, and they don't realize the process, what happens next, how the loan is sold to the secondary market, etc. So you have these elements that happen to our homeowners that they know nothing about. And so it makes them less likely to communicate with lenders. Think about those statistics I gave you earlier. If majority of our clients are underbanked, and not being served by a financial institution, what is the likelihood of them being able to navigate this process once they get to a default situation? Communicating with the lender. It's not going to come naturally to them. So we have to talk about the process, pre-foreclosure, foreclosure, and then avoiding scams. I like to think of it as, you're drowning and there's sharks in the water. Like it's not enough that you're already in a stressful situation, but then you also have to navigate the people that would take advantage of you. And sadly, that's the case when it comes to foreclosure. So, one of the questions I like to ask my clients is, how confident are you that you could come up with $2,000 if an unexpected need arose within the next month, right? Think about it like this. This isn't a tire, right? This isn't an emergency fund, a quick $200, $500 thing. If you needed a considerable amount of money, where would you take that money from? More often than not, our clients would look at their mortgage payment and forego making their mortgage payment to come up with this money. And so that's what we're trying to avoid. So this particular slide says in January 2020, about 1 in 4 Americans were financially fragile. Then you could say those numbers are much higher in our communities because there wasn't a whole lot that could be done. Most of the tribal communities were shut down with limited access. So the percentage of people who said that they could certainly come up with that number was 51%. 22% said they could maybe come up with some of it. But 27% said I probably would not be able to come up with it, or I'm certain I wouldn't be able to come up with it. And that's a scary thought. So, how can we help our families absorb financial shock without breaking, right? What does that look like personally? You see it within families all the time. If you have clients coming in together, then typically, they're drowning together, and there's a little bit of a blame game, right? In some cases, maybe everyone's to blame, but someone is feeling the guilt. Professionally, someone doesn't have that same pep in their step. They're coming to work, but they're barely there, right? It does have an effect on you when you're financially when you're not as stable as you feel like you should be. It's going to affect you both personally, professionally, and then lastly, spiritually. You see people just withdraw altogether. So what does that look like? I like to think about the Maya Angelou quote that says, when you know better, do better. Well, what happens when you know better and you don't do better, right? Or that feeling of guilt, frustration. Everyone's excited for the idea of home ownership, but no one really foresees, what it's going to feel like when you can't make your mortgage payments, right? So guilt, frustration, anger. I know better, but I didn't do better. And then there is a sense of hopelessness. In 2007, the arm adjusted. I had no earthly clue how I was going to make my payments. Outside of making more money, right? That's like the quick, easy fix, is to say, okay, well, I'll get a second job. That doesn't always mean that you're going to feel any better. If anything, it might make you feel worse because now you're not sleeping as much and you're working twice as hard. Anxiety and fear. You might lose your home. You start thinking about how this is going to affect your family. And then in most cases, people just shut down altogether and they avoid the situation. And, they stop answering the phone calls. They avoid going to the mailbox. They just do what they can to not have it, a constant reminder that, they are very close to losing their home. So, I like to keep it light. This is a tough topic, and one that I understand um, our clients don't always want to hear. But, wherever you can, find some funny ways to stay connected and stay positive. So Garfield says, I hate change. I didn't used to, but I've changed, right? So, I mean, eventually this process makes you change certain ways, habits, things that you might do or would have done. Like I said before, that $2,000, they might have taken it from their mortgage payment, but after having a conversation about meeting financial obligations, we came up with other solutions. So we got to prioritize, our home ownership expenses. We typically talk about fixed and flexible as it relates to pre-home ownership, that idea that I'm going to go ahead and save for a down payment. But once you're already in a home, then you got to prioritize monthly mortgage payments, life insurance, car insurance, utilities, cable, lawn maintenance. You might need a kitchen remodel, an additional bedroom. You got more family staying with you. You might need a new HVAC system, or maybe a new roof or something like that on the home after a couple of years. So there's a lot of things that your clients are trying to balance. So they need to know what they're saving and what they're spending. And this is how they do it. They have to determine what their needs are versus what their wants are. They have to take control by tracking, assessing, taking action, and then saving wherever they can. But the first step is by tracking current spending habits to see what they can cut back. Estimating future expenses for sure. Looking at ways to make sure your budget fits your income. And then reviewing the budget regularly, because this is one thing. Most people think it's set in stone, and it's really not. It's something that should be reviewed. And you will make mistakes. It won't happen overnight. The details of your mortgage itself. They need to know how much is the principal, what am I paying in interest. If I'm off reservation, then I have taxes. I have the tax element and I have the insurance element. And I will say those things are increasing, which means that your payments are increasing just as by nature of what's going on in the market, right? Everybody's excited when they see that their house has increased in value. It's like, hey guys, I bought it for this and it's worth this now. But they forget that this is also something that your local county tax, your assessor, your tax assessor, they're assessing the value as well, because they also have to pay, charge you taxes on that. And so when that happens, people get up in arms and they're kind of upset about it because they don't want their payments to go up. Same is true of insurance. Ask the people in South Florida, Florida in general, California, places where natural disasters have really hiked insurance costs. You can see that then that has an effect on your payment as well. So do our homeowners, understand that? I have had it happen where people were in the pre-foreclosure process. They weren't making their payments, not because they didn't want to make their payments. They were having their payments taken out directly out of their checking account each month. And what they failed to understand is that when the taxes and insurance changed, they never changed their payment amount, right? So here the bank is sending their payments in to their bank, to their loan servicer, but it's the wrong amount. And banks don't accept partial payments for a mortgage. That is not a thing. This is a different, that's another element to this that our clients are maybe not familiar with. An entire, whatever you've agreed upon, they will not accept a partial payment for your home ownership, your mortgage payment. So what happens to that money? It doesn't disappear. If you send them less, it gets put into a separate account. And once you have a full payment, it is applied to your account. So in that particular case, we had to do some digging, get them caught up. We explained to the bank what the situation was, or the loan servicer, and we were able to get it cleared up. But yeah, these things do happen. So again, going back to spending plan details, this is the first time they've ever had home maintenance costs. Maybe they relied on the housing authority or the tribal housing department before. So things like repairs, painting, yard maintenance, these are the kind of things that they have to be aware. There are costs, and those are rising as well. It's not what it used to be. So, I think if you can check in and say once a quarter, have a class for your clients to talk about these things, they would benefit from it, even if it's on Zoom or something like that. Utilities, water, gas, electricity, trash pickup. There's tons of information going out there in regards to energy efficiency. They may be weighing an option of buying an energy efficient appliance, but they think maybe it's too expensive. If you had a class that talked about energy efficiency appliance, have someone from your utility company come out and do that sort of talk. That's what we've done. And so I've worked with the Cheyenne River Housing Authority, and their group, Morro Grande, comes out and talks to clients about how to just be more energy efficient using the right light bulbs, looking for uh, energy vampires, right? Keep things that are plugged into your household, looking at windows and doors, and maybe even electrical outlets to see where heat is seeking from these areas because they're not insulated. So just thinking about it from a different perspective could save them some money. And then lastly, of course, unexpected repairs that they might have to make, um, which leads me to crisis budgeting. So when you're in a place, it's funny because we call it financial wellness, but we also call it financial health, right? Financial health is important. And so when you're in a crisis element, you've got to assess your situation, prioritize your spending, and create a new budget. That's the first top three things. And some of our clients don't come to us for that. They may not know that they can. Financial coaching, if you're a CDFI, then you already do these things, but do homeowners know that they're available to them? Rebuilding savings, right? So maybe they've had to tap into their savings to account for not having income for that month. They're taking care of a loved one, and so they're not working as much as they usually would. They got to figure out a way to make it work, and also rebuild some of that savings that they cut into. Start with an emergency fund, because I don't want a flat tire to be the reason why they start using credit. Going into that, then you can see that we also need to manage debt, and find ways to eliminate debt wherever you can. Of course, that making the minimum payment means you're going to be making the banks certainly more money if it's a credit card situation. If it's a loan, you want to try to pay that down as much as possible. But interest rates are higher than they have been. I forget the actual numbers, but essentially during the pandemic, we saved a lot of money as a whole. The country did. And then once we reopened, people started using their credit cards. So credit card debts are on the rise, by leaps. And that's a scary thought when you do what I do, because you know what comes next. Take advantage of automated worksheets or any sort of apps that help you manage money. One, money vampire is, just the sheer number of apps that might have access to in-app purchases, right? Think about how, if you're paying for Netflix, Hulu, Apple Plus, Prime, and the list goes on, that's a pretty penny that's out there, right? In addition to your taxes, utility, auto bill, credit card, mortgage, all of these things. So just thinking about how apps can both help and hurt is a good conversation to have. I like to provide my individuals with sound calculator options, because also too, I want to avoid them getting solicited by banks or other institutions that maybe don't know anything about Native communities, and may not be serving them in their best interest. So, what is your credit balance? Well, it puts it there. Then they input their interest rate, your minimum payment, it does this for you. And then you can calculate, what that looks like, and it gives you more information. So, and I also advise them to use, so this actually came from within a banking app. So this person was already signed in with that, as opposed to like having to get another app, a third party, I guess I should say. So for me, if you're already using Capital One and they've got tools and that you could tap into and use for free, do that. I'm not crazy about these third party apps, because that's one more person that might have access to your personal information. So the other top 10, or the last 4. So protecting your, or 3, excuse me, protecting your credit. Um, Again, not just by way of managing the debt, but also checking your credit score, right? Checking your annual credit report to see that there isn't anything on there that's fraudulent in nature. Putting a note, you can put a note in there that there's a financial stress going on right now, an element going on right now in your household, requiring you to just pay the minimum payments. Resist the use of predatory lenders. So this is a big one. Once you're in that, once your balances get high, you start to get these consolidation letters. And that can be kind of scary because you think, okay, well, maybe I should do that instead of working with a housing counselor. And so this is why you want to resist the use of predatory lenders. And then negotiating your bills and service contracts. There's nothing wrong with saying, wait a minute, I don't really think this makes sense for me anymore. Real quick, I was trying to eliminate some monthly expenses, and I called Audible, not to single them out, but well, no, I tried to do it on the app first, and it wouldn't let me. I had to do it online. So I went online, used my laptop, I go on there, and the first thing it said was, "You sure you want to cancel?" And I'm like, "Yes, I'm sure I want to cancel." And then the next screen after that said, "Well, what if we went to every other month instead of every month?" And so I thought, my goodness, if I had no willpower, I might just keep keep this going, right? Because part of me wanted to keep it. But I do think that, we're in control. Banks are businesses, businesses sell products, and every day we have to make a decision. And I know we get fatigued. Like it's like almost too much to have to make all these decisions an adult. But in this particular case, we should negotiate as many bills as we can. We don't know until we ask. Maybe my electricity company has some sort of way that I can get back on track. Maybe by communicating with my lawn guy that, once a month as opposed, or once every 3 months, just to manage the larger shrubs or whatever. And then I'll deal with the lawn myself. There's nothing wrong with me or my kids doing that work, right? So, if I'm going to make these changes, I've got to change my habits, which may not be to communicate with these folks, but just pay them what I owe them. I got to get in there and get in the trenches and see where I can adjust those bills. And then seek financial assistance from service providers. The last thing here is just taking care of yourself, your family, and your health, because that stress of not being able to make those mortgage payments have led to a lot of mental health issues as well. So, not worrying to the point of getting sick. We want to make sure that folks know that the opportunity for financial resilience is out there, and it starts by protecting yourself. Going to a housing counselor, or someone that as practitioners, if there's someone that you should be advising them to go see, putting that information out there for them. One thing I wanted to note, going back to like the buy here, pay here's, or the buy now, pay later. This is the new one, right? So it used to be buy here, pay here, especially when it comes to cars and things like that. That the interest rates are high, but because we're underbanked, we're not working with you know traditional financial institutions. They're not necessarily getting the best interest rates, or they're getting denied, and so they have to go to these places to get a car. Now, buy now, pay later exists everywhere. If you make a simple Amazon purchase for $50, it'll say, "Do you want to pay $2.30 for the next 6 months?" I mean, it's just nuts to me that's an option. But the Consumer Financial Protection Bureau has launched a market monitoring inquiry into the buy now, pay later situation. Because the other thing is, these aren't reported on credit. So when you, as a home ownership counselor, looks at someone's finances, we don't know how many buy now, pay later situations that individuals have put themselves in. You see it for recreational, for vacations, for roofs and HVAC and other things. I mean, it's pretty much everywhere now, and can be used. Maybe it's just me, but I see it in places where I didn't always think it was an option. So, yeah, and feel free to put it in the chat area. Thank you for including your name and where you're located, in case there's anyone just like you somewhere else. You guys can network. But yeah, if you're seeing buy now pay later, put it in the chat area. Let me know if that's something that is helpful to you to know that at least the CFPB is on it and that they'll hopefully come up with some more guidance. But why does that matter? Because we're trying to make sure that our clients have as much disposable income as possible. And if they're using these instruments, it may not be the case. So, what a difference a couple years makes, right? March 2020. So real quick, March 2020, the interest rate, a mortgage interest rate was 3.7%. March 2021, it was 3.5%. March 2022, it was 5.3%. And March this year of 2023, it's 6.3%. So a whole percentage point higher. So certainly the cost of purchasing a home has increased. There are a couple things I want to highlight about interest rates. And this is going to bring me into that refinancing discussion that we need to have. So the first thing is that since 1975, right? This is a chart that just gives you information regarding the average 30-year rate. In 1981, it was 16%. This is kind of fun. Go ahead and put in the chat area, if you were with me in the very first class on the housing market, what is interest rates tied to? Or not tied to, but what kind of relationship do they have? There's another economic term that we're currently experiencing now, hint, hint. But there's a connection there between interest rates and Elizabeth for the win, inflation. That's right. When interest rates are high, typically inflation's high. And so when we go back to interest rates, now the Federal Reserve, they're the ones who monitor how much money is flowing within the US economy. And typically they'll increase interest rates to reduce the amount of money that's flowing in the economy, and vice versa. If the economy needs more money, they may lower interest rates so that the cost of borrowing is less, right? Makes people feel motivated to purchase items. And so that's, now there's a group out there, I don't know if I've got some in the room, that are laissez-faire. They say, leave the economy alone, don't touch it, let it do what it does. And you have others that say the government should be involved in the process. I don't land in one place or another. I'm just giving you the information as to how it works. And as practitioners, typically in affordable housing, we don't care at all. Like, all we want to know about is how to get people qualified. We want to teach people the specifics. So it's funny to me that interest rates, although it affects behavior, isn't something, I even introduced myself to until much later in my profession. So I do encourage you guys to keep up with these types of things, because your clients, if they're afraid to purchase a home now, I mean, you can show them this and say, well, I know for sure people in 1980 were buying houses, right? Not to steer them in the wrong direction, but just kind of show them this is a cycle. This is a process. The interest rates will change. The next thing I want to show you is 2008 and on. As you can see, there was a crisis. And so the Fed decided to lower interest rates, which eventually meant that mortgage interest rates would lower as well, because we were needing to feed the economy and get it moving again. So you see interest rates take a dive. The lowest interest rate on record is 2.96% in 2021. And that's really at the height of the pandemic. It's at this point, it's only a year out, and there's still a lot of confusion in the market, and in the world, really, as to how to address it. So I say that because if you had a mortgage, let's say you were and since 1992, Section 184 has been around. So if you were one of the first borrowers of a Section 184 loan, what should you have done in 2021? Put it in the chat area. What should those clients have done if if they still had a considerable amount left on their mortgage? Linda's absolutely right. Refinance. And this goes back to what I was saying before. So if you know how interest rates work, and interest is the cost of borrowing money, then by lowering your interest rate, you are now reducing the amount that you pay monthly. That might have had a huge effect on the space, right? The mental space of knowing I have a mortgage payment that's now less by $300 or $500 or even more. If you had a high one in 1994, that interest rate was 8.3%, right? So, or even in 2007, it was 6%. So what we can do, and I caution you all, you're not economists, you're not financial advisors, but just the sheer information and understanding how interest rates work could save them money, could save our homeowners money. So this is why we bring it up. And I think if you do it in this way, it's pretty safe. You're not advising them to refinance, you're just explaining how it benefits them. And you can always take this chart to your lender and say, hey, can you pull what the mortgage, let's say someone owes $225,000, what would that payment look like? Right? Give them the numbers and let them run it so you know it's correct. Because as I said, I myself get some math anxiety every once in a while. And so I go to my loan officer and I have them run the numbers, and then I give it to my clients to give them an understanding of how it works. Refinancing terminology, they've got to know exactly what that looks like. And then home equity lines of credit, or HELOC, if you ever heard it called that before. We'll talk about that next. So refinancing. Roughly 2.8 million homeowners refinanced their mortgage in the last quarter of 2020, which saw record-breaking $869 billion in refinance. So refinancing was like, the industry as a whole was shocked. Like they had way more people than they had the ability to refinance. Like it was, if you knew to do it, right? And so this gives you more information as to what that looked like in 2020 and 2021. Over a single week span in March 2021, mortgage applications increased by 55% compared to the week prior. So a lot of it homeowners did, but when we talk about generational wealth, when we talk about redlining, we talk about all the ways in which Native communities, urban communities with large Native populations, a lot of them, this is their first home. They do not know about these instruments, and so they didn't know to refinance. And we had that happen in a lot of Black and Brown communities as well. So we, as the housing counselors, can start to put this information out. The first thing is the definition. A mortgage refinance replaces your current home loan with a new one. And then that way you can take advantage of the lower interest rate, shorten the term, right? Instead of 30 years, you might do 15, based on how much you owe or what's left on the loan. And then also it can replace, if you're in a negative situation, right? Like a adjustable rate mortgage, you might want to go to fixed rate because that's safer for our clients. Then that's what it's meant to do. So rate and term finance is the basic. And the primary goal is to lower an interest rate or change the terms or both. And then this type of refinance doesn't involve taking any money out of the home itself, the equity of the home. I didn't talk a whole lot about this, but I'll give you the visual. When you make your mortgage payment, you've got principal and interest. Think about it as a pair of jeans. You're putting some principal in your pocket. You're putting interest in or money in the pocket of the bank, right? Because that's the cost of borrowing. So you're paying them back. But that money that's in the other pocket, the principal, that's yours. That belongs to you. It's invested in the home. It belongs to the home. And so the home has equity. It has value. So when we say that the refinance doesn't involve taking any additional cash out, you've changed your interest rate. You've lowered it. That's cool. You've changed the terms potentially, but you haven't taken any money out of that particular loan. So that's a good thing. There is a version of the refinance option which does allow for cash out. And so with a cash out refinance, you're refinancing your mortgage amount for a higher amount, right? Than your current loan balance. And so the example I'll use is, let's say you owe $100,000, but your house is worth $200,000. Well, first things first, that $100,000 that you have that belongs to you, that's in your pocket, the bank won't let you take all of it. They want to be safe. They don't want you to put yourself in a financial situation that you can't, where your loan where your asset is in jeopardy, right? So they'll only let you take, I think it's 80% of that, right? So, you might have $100,000 in equity. They'll let you take $80,000 out, right? And that is the refinance itself. Now, on the flip side, if let's say you've only had your home for a couple months, and so or maybe a year or so, and you only have 15% equity in the home, right? Not a whole lot. Um, you know, they're not going to let you take out a refinance on, you know, that particular amount of equity. I think you have to have more than 20% equity to think about a refinance, um, or a cash out. Uh, so the difference between the new loan amount and your existing amount is what you receive in cash, as I said before, minus the fact that they won't give you all of it. You can use the cash out refinance for different things: home improvements. Some people use it for debt consolidation, education expenses for kids, financial needs. Let's go back to generational wealth. We talked about that in a couple of the other classes, but at the end of the day, one of the reasons why the wealthy stay wealthy is because they don't have to start over. Or if they need money, they have an asset to pull that money out of. And this is what we mean by that. So being more familiar with this particular instrument is good. We may never use it, but it's good to have. The streamline refinance, I have to kind of break this down a little bit because it's something that's offered by the government-backed loans. But essentially, and did I skip that? Let me double check. Oh, okay. It's coming. I always wonder sometimes. Okay, so to go back to streamline refinancing, what you need to know is that it aims to simplify the process by requiring minimal documentation and paperwork. Now, since we're replacing one loan for another, then you still need to provide just about the same level of documentation you would have when you purchased your home. That's kind of one of the parts to refinancing that people aren't familiar with, or they're concerned. Like, what if I'm not in a good financial situation to refinance? Which is partly maybe people knew that they should refinance, but they couldn't, right? Because they had delinquencies, late payments, etc. There's some of that going on here as well with this. So it's good to know that there is a streamlining option where there's minimal documentation and paperwork. It's basically, just like the FHA or the VA loan, you have to have certain criteria, right, or eligibility, and then they won't have to do a full appraisal. They know that the home has value. They don't need to do an extensive credit check. They know that the borrower has the equity to move forward. But the streamline refinance is also has some I don't want to call it restrictions, but protections for the consumer, right? Because you're not taking if you could afford. I guess the argument would be if you could afford a conventional loan, then you wouldn't need to have used FHA or the VA or the Section 184 loan product, right? You would have been able to do it with the conventional model. So in this way, they want to protect our clients by saying, let's go ahead and reduce the amount they can cash out. So, and we'll see that once we get to Section 184. How does refinancing work? Well, it still requires you to qualify for the loan just as you had to meet the lender's requirements in the original loan. So this is the slide I was looking for. I wanted to make sure everyone was aware of the fact that you're still doing the same stuff, getting an application going, you're going through an underwriting process, you're going to closing, you're paying for closing. That's one element to this that people may not have the funds to close, right? It might be a couple grand to close a home loan. So, or to refinance. And so our clients are definitely not familiar with the second part, right? Knowing that they have to pay more to refinance. I've got to pay money. Some people may not think that that's intuitive. Why and when you should refinance? Well, reducing your monthly payment is one. Tapping into the equity I talked about. Paying off the loan quicker, right? Once it's more affordable, maybe you can double up on payments. Removal of the private mortgage insurance. This one's a little tricky because I know that with FHA, for example, you're no longer able to refinance out of private mortgage insurance, even if you have equity in it. But then other loan products allow for it. So it just kind of depends on which one is selected. So show of, we'll see, I can't get you to raise hands, I don't think, but if you want to put in the chat area, if you were with me for section 184, what I want to do is I'm going to go through it, lightning fast. I need to talk about section 184 before I can talk about the refinance options, just to make sure everybody is on the same page in the same book. So section 184 is it's administered through HUD and the Office of Native American Programs, and it's a loan guarantee. Essentially, it's a government-backed loan, and it can be used on fee land, tribal trust land, allotted trust land, and restricted fee land. All the definitions are available to you in my other presentation if that's a little confusing to you. Eligibility for Section 184, you have to be a Native American enrolled in a federally recognized tribe, Alaska Native. Tribal housing departments can certainly use it to increase capacity and leverage those resources, TDHEs, THAs. Maybe I shouldn't talk in HUD. Tribally designated housing entities, tribal housing authorities, or the tribe itself. Get ahead of myself. Native Hawaiians, those relatives can access a similar homeownership loan through Section 184A. It just happens to be funded through a different act of Congress, so it's got a different name, but it functions very similar. Section 184, the partners in the process, of course, you've got HUD and ONAP, the lenders themselves. So it's private lenders can choose to sign up for the program. And so it's not like not everyone does it. That's one thing to note. Depending on your location in your area, you might have to do some research to find the lenders. But then there are also some national providers, meaning that they work from California to Maine. And of course, the BIA, because they have to issue, if you're on trust land, they have to issue the title status report. So they're involved in the process as well. Why should you use the loan? Because it's a low down payment. It's 2.25%. For any loan over $50,000, and then 1.25 for under $50,000. Low interest rates. So it's based on market rates, but not an applicant's credit score. So what do we mean by low interest rates? Meaning they're paying attention to what's going on with an individual, and it's not just the score that determines the rate. Typically, if you have a high credit score, if you have a low credit score, then you look like a risk to the bank, and your interest rates would be higher. In the case of Section 184, it's got manual underwriting, which is huge. It means it's not a computer, it's a person that's looking at your documentation, looking at your financial health, and making a decision based off of that. So other things about Section 184, no income limits. That's a big one because a lot of folks, when you work in Native communities, we've got our essential workers, our folks that are, providing our teaching, right? Our teachers, our first responders. We got individuals who are maybe making more than affordable housing limits will require. That AMI, that those amounts may be so low that they don't qualify for support or help. So the good thing about Section 184 is that even if you make higher, you make moderate income, not even high, but moderate income, you can qualify. It's not credit score driven, as I said. No private mortgage insurance. Remember, it went to zero from 0.25 to zero. That's a good thing. Flexible underwriting, low down payment, 41% debt to income. This is a big one. The industry average is 36 to 38%. So if you go conventional, or even some of the other loans, they're cautioned. The argument being the more debt you have, the less home you can afford, right? So in the case of Section 184, it's a little bit higher than the national average. And then, of course, the market rates itself, they pay attention to that. So this is the loan service areas. It's basically either approved in all of these states or portions of the states. And so all of that information can be found. The link is there. And this is as of April 2023, by the way. So fairly recent. They do update them. So for me, I'm constantly throwing stuff in my trash can because it's from, I want to make sure I'm giving them the most recent information. Section 184, the loan limit. So this is also something you need to check out because depending on the county you live in, the maximum loan amount might be different. Think about a house in South Florida or California or New York versus a house in South Dakota or North Dakota or Montana. right? So those price points are going to be different. And so that's why there's maximum loan limits based on counties. What can you use it for? You can purchase an existing home, construct a new home. It could be site built, manufactured, permanent foundation, stick built. You can rehabilitate the home. You can purchase and rehabilitate a home. So you can do either or. You can refinance and that rate and term streamline cash out. We're going to head there next. You can use it for single family homes, but 1 to 4 units. This is a big one because you got some folks, especially going back to future home buyers, that there are some that are super savvy and they say, look, I want a 4-unit, I want a fourplex. I want to live in the first one. I want my mom to live in the second one. And then I've got cousins and relatives I can rent to, right? So the options are out there. There are different options for folks that could really be a benefit to the community if they look into it and they learn more about it. So of course, if their income will allow for it. Section 184 strives to increase homeownership across Native communities. And so the construction loan itself is single close loan. So that means your rate is permanently locked at closing. Sometimes with construction, you can have multiple closings. And so this is good that you can do a single close on it. I do want to remind everyone that the contractor has to also go through a process. It can't just be, someone you have in mind. This person has to get qualified to do the work by HUD. Once they're approved to work with HUD, it's not upfront payments. It's actually done on the back end, right? So they have to pour the foundation and then put in for a draw. They have to, put up the framework and then put in for a draw. And so there's several inspections that have to happen so that the builder will get the work. Well, if you choose a builder that doesn't have that capacity and can't hold those costs, then that could be a problem for you in the long run. So just being mindful of how the construction process works. There's also a 10% holdback or contingency, meaning they won't give them all the money up front. So if the foundation was, I don't know, I'm gonna, pull out a number, $8,000 to pour the foundation, they're only going to get, I don't know, a portion of that $8,000 because there's that 10% holdback. So $800 will stay back. Loan features. So you can do 30 or 15-year terms with Section 184. You can do a fixed interest rate. They don't mess with adjustable mortgage rates, so don't ask. 1% loan guarantee. Remember, it was 1.5. 2.25% down. No adjustable mortgage rates. No commercial structures. People ask because, if you work in a rural area, a lot of people have agriculture and things like that. So, of course, they'll look at your credit history. So I encourage you all to take a look at that, because where they're not looking at your score, they are looking at, okay, well, is your foreclosure at least 3 years old? Is a bankruptcy at least 2 years old? Do you have any court order judgments or liens, things like that? If you have no credit, then, do you have at least 2 trade lines for 12 months? They want to make sure that you've got the right income. So they'll look through this list to determine that. And then they'll also tell you what to avoid, right? So you got to have the funds to close. It can be done in different ways. Gifts are allowed by family members, etc., and all these other ways. So I want to make sure I highlight that. And the last one here says tribal down payment assistance. So you can get assistance even in a refinance situation as well to help with closing costs. Just depends on your tribe and if you provide it. So the loan application, you'll see that you still need to do these things. And these are the same things I mean when I say that you'll have to do them for refinance as well. So these are the tips that that a loan officer himself provided. So I wanted to make sure I add those to it. Avoiding large deposits, transfers. Everybody's got Cash App, Zelle. God, there's so many out there. But make sure you're careful with that, because you're turning those bank statements into the loan officer. If they see overdraft fees, that shows that you're not able to maybe manage your funds like you need to own a home. So be careful with that. So review those things, and then remember your escrow. If you're on reservation, it's just insurance. If you're off reservation, it's insurance and taxes. And those things need to be accounted for. So refinancing under Section 184, they've got the no cash out option, a cash out option, and a refinance option that's streamlined. And that's only 184 loan to 184 loan. Like you can't do a streamline refinance from conventional to Section 184 because there is that they're not taking as much in terms of documentation. So it's got to be a loan they've already closed, and so that means they know more about that home loan. No cash out is simple. If your current loan is not a Section 184 loan and you're refinancing into a Section 184 loan, then you can do that. Now you can do a cash out if you need to consolidate through Section 184, but as I said before, in this case, the industry standard is 80%. They're going to allow you to take up to 85% of your value, but you're only allowed to receive $25,000 in cash in hand. So what does that mean? That means that if you have a list of let's say you're trying to consolidate debt, you've got a lot of debt and you're going to cash out some of your equity there so that you can pay those debts off. Well, they are going to get the names and the account numbers and they'll pay them off for you. They won't allow you to take the cash out and then pay them yourself. They don't want to do that. And what happens if you don't make those payments, right? And you just kind of pocket the cash. Not to say that that's what happens, but if that were to happen, this is all in an effort to protect the consumer. So to protect our clients. So they can only receive up to $25,000 cash in hand. Any questions there? Check the chat. I don't see anything, so we'll move on. These are the typical documents you're going to need. Once again, deposit towards new appraisal. People don't realize, especially if the first home buyer process kind of flew over their head, but you, the buyer, the borrower, is paying for the appraisal, and it could be anywhere between $600 and $1,000. So, depending on where you live and the square footage of the home and all of that. So with the streamlined process, you're not going to need as much because you have a 184 loan, but they don't need a new appraisal. They don't need to verify your income or your asset. So that's good. They're just going to make sure that they've streamlined the process. It doesn't take as long. Let's see here. So the loan guarantee fee is non-refundable and may be financed or paid in cash at closing. So, they have the option of both, of being able to roll it into the mortgage or pay it at closing. And again, that's 1%, not 1.5%. Now, the borrower will not receive credit for the fee from the loan that is being paid off. So that's just one thing to note. The barriers to refinancing. So why don't people refinance? Part of it is employment stability, right? So I like to look at it like a financial picture. If I take a picture today, think of the old school camera. I take a picture, and my financial picture doesn't look good. And what if I don't have employment stability? What if I, don't have the amount of income I used to make? Then I may not be able to refinance. Stricter requirements, going back to, what will be required of the borrower. Maybe your DTI is 45% right now. And when you got the loan, it was, 36. So that could be a requirement that's now hurting you. History of late payments. So of course, as the lender, they are able to see your late payments reported in your credit report. That could be a no-go. Also, non-sufficient fund, right? When you get those overdraft fees, that accounts for or makes the financial picture not look as great. Appraisal. So with both no cash out and cash out refinance transactions, the new appraisal is always required. So that's something to note. So let's see here. Can they refinance multiple times? So the answer to that is yes, but there has to be the benefit to the borrower in terms of the equity itself being there in the home. Remember, I said they won't let you take out like, let's say if you only have 20%, less than 20% in equity, then they're not going to be able to let you. More than that, and they'll have to look at the circumstances surrounding it. So for example, if If interest rates are at 6% and your interest rate is currently at 3.5%, then it may not make sense, right, for the bank. So that's part of it as well. Homeownership resilience. So we've talked about a lot of things, but the last thing, and probably the most important thing for our talk, is the repayment process, right? Communicating with loan servicers, free foreclosure, and avoiding foreclosure scams. So the first thing is speaking to your lender. Homeowners are supposed to get affordable repayment plans. Look, in 2008, it was a hot mess express. Like nobody knew what was going on. Most people really hadn't been through the mortgage foreclosure process, and so many were doing it at the same time that it just the whole system was taxed, right? The banks, the lenders, the counties and the municipalities that had to process foreclosures. It was a nightmare. And so homeowners are supposed to get affordable repayment option plans, consumer protection. One of the big things that came out of 2008 was the Dodd-Frank Act. So when you have them to thank for the loan disclosure, for the closing disclosure and the loan estimate. All those documents that we now rely on today come from that, because people were like, "Can you spell it out for me? What exactly is my, does this all mean as far as my loan and what this looks like?" So I encourage you all to take a look at a closing disclosure if you haven't recently, just to kind of get familiar with that, because even in a refinance, you're going to get the loan estimate and a closing disclosure when you go through this process as well. So going back to protecting your home, banks had to do a better job. So every bank, if you go to their website, they have clear foreclosure guidance available to clients because it was so confusing. So the first stop is always when you're in a financial hardship situation, your first stop is your lender/servicer. Now, the loan officer that you worked with, the loan officer himself or herself may not be the person you now connect with in regards to your payments. That is a big difference. A lot of folks don't realize that your loan servicer is a different entity. Usually, typically, it has a different name than the person that you worked with to close your loan, right? So that's important to know. Due to the number of homeowners affected by the pandemic, lenders had to they have an increased volume of calls and online inquiries. Why do I say that? That means that our clients have to know if they're in a foreclosure prevention, pre-foreclosure space, they got to be patient, they got to be persistent, and they got to be prepared. And not just to spend time on hold, but also to get through this process, because it is going to take time. Going back to my experience in 2007, and this is a really human experience. You're already feeling that list of things I mentioned earlier, the guilt, the frustration, the hopelessness. And then you get somebody on the phone and you got to explain to them what's happened to you, right? And that's cool. You do that and you think you're good and you give them everything, and then you don't hear from anybody in 2 weeks. So you call again, you get a different person, and now you've got to explain this process that, what happened to you again. Eventually you get to a point where you stop wanting to tell your story. And that's what we want to avoid. That's what we want to make sure our clients don't experience that. So they got to be patient, they got to be persistent, and they got to be prepared to spend time on hold and potentially talk to different people until they get the right one. So leveling the playing field means we have to understand the mortgage payment process. Mortgages are contracts. They have terms and conditions. And when you don't comply with those terms and conditions, then you're in violation. And that's when you become in default. When you don't make your payment like you said you would, you're in default. The borrower remains in default until the loan is brought current. So going back to that circumstance where my client made their payment, which they knew to be $1,500 a month, but because of taxes and insurance, it had actually gone up to $1,550, right? Well, that extra $50 meant that they weren't actually making their payment. So what happened? They paid the first $1,500 and it went into an escrow account. They paid another $1,500 and went into an escrow account. There was $6,000 sitting in that account. And then the whole time, my client was going into foreclosure with their home simply because none of those payments had been applied. They were short. These are the kind of things our clients are not going to be aware of. There's no such thing as a partial payment when it comes to a mortgage. So what happens when you're in the next stage? or you're in the stages of non-payment, the next one is delinquency. Or the first one, I should say, is delinquency. That's when you failure to make your payment. Typically, there's a 15-day grace period. Some loans are 10 days, some are 15. It just depends on what you've agreed to. But after 30 days, you're considered delinquent. The term default kicks in when you're 30 days past due. So, and then of course, foreclosure is when the lender decides to seize that asset, take control over that asset, sell that asset in order to recoup their funds. So the next one is short-term relief of payment options. So of course, you can always try to enter into a repayment agreement, right? So you call your lender, you talk to their loan, they call it loss prevention or loan modification office. But they're there to assist you. This isn't just your customer service rep that you would call to call in your payment. This is a step up, typically from that individual, where you're going to go ahead and create some sort of repayment option. Maybe you take your $3,000, if it's a $1,500 payment, you now owe $3,000 plus some fees here and there. They may decide to split that in 3 so that it makes it a little bit more affordable for you to get back on track. And after 3 payments, you're back on track and everybody is happy. The other thing is forbearance. Forbearance is a little different, and I'll define that in a minute. There's the loan modification, which we'll talk about, and then the partial or advance claim. Of course, there are long-term solutions. Typically, these are the ones you hear about. Those other ones are kind of like in the background. That's the first step. We like to consider those pre-foreclosure. The long-term solutions are sale of the property itself, the foreclosure of the home, hardship assumption. We'll talk about that. Pre-foreclosure short sale. That's an option. Deed in lieu. That's also an option. And then the foreclosure itself on the home. There can be the sale of the property without the foreclosure. What we're trying to do when we're in this space, and this is why it's in like that orange red, is that we don't want it to affect the person's credit. Selling a home might be the only option, right? If the primary caregiver, not just caregiver, but primary breadwinner is no longer in play, it happens with divorces. If that person passes and there's no way of making that payment, then maybe giving up the home is the only option that's available. Do you want these individuals to also have to worry about starting over credit-wise? That's what we want to avoid when we're in this stage. So, because your credit takes a hit when you start to go into non-payment. So the first player we got to talk about is the lender, right? They make the mortgage loan to the borrower. They determine whether the borrower has the capacity to repay the loan. The loan servicer are different. This loan servicer collects and transfers the mortgage payments. They manage the escrow accounts, the payment of taxes and insurance. They provide the mortgage assistance to the borrower. So going back to who picks up the phone, and they're the one that administers the foreclosure itself. So if everyone remembers back when the CARES Act was still in active, it provided support, and it also provided a foreclosure moratorium. And so essentially people couldn't foreclose on a home, banks couldn't foreclose without having going through, well, one, they couldn't foreclose on the home, but 2, they had to provide support. So a lot of people didn't know who owned their loan, right? Who their servicer was. So there's these lookups where you could go. Fannie Mae had one, Freddie Mac had one. You can't assume that your loan is Fannie or Freddie. You have to do the background work to determine who owns your loan, and then where you needed to go for support. So the forbearance agreement itself it reduces or suspends the payments for a set amount of time. So at that particular time in 2020, 2021, you could say I was affected by COVID, and they would suspend your mortgage payments for a period of time. And then they would determine, they're not waived or forgiven. It's not like, you do have to pay it back, but it also doesn't cover taxes, insurance, and condos fees, right? So these are the kind of things that maybe help you in the short term, but in the long run, the client is going to have a solution. The other thing is when you're in forbearance, the mortgagee, the servicer, whoever is suspending the payments, they won't report delinquencies. So that's what I mean by protecting your credit, even when you're in this situation. And that can only be done if you're talking to your your servicer. I've had the pleasure of talking with Dark Feather and Chetta with First Tribal Lending, and she kind of works on that second on the client relations side to talk with homeowners about what the struggles that they face. And a lot of our clients, they just don't, they're not comfortable communicating with the servicer. The moment they get her on the phone, they're comfortable as a community member talking to her, but these servicers, they don't really want to talk to them, and that's understandable. That's just a part of this the community we serve. And so in that way, we can do what we can as housing practitioners to maybe support them, explain the process, and give them more guidance, or just be that third party. If they can provide you with some sort of release, then you can be that third party in the room helping them when they're on the phone. So servicer responsibilities, again, is to determine the reason for delinquency, and provide our clients with some options. Determine if the borrower can reinstate or repay the debt. Educate the borrower on the availability and the workout options that are available. Obtain commitment, right? So they're the ones who turn in that. I remember, gosh, when I finally got my loan modification, I had to take it to a place and get it notarized and send it back to them. And they wanted the original documents. This was before, e-sign and all of that. And so, if I didn't have any guidance, I don't know what I would have done. I luckily, doing what I do for a living and having an understanding of how this process works, made it easier for me to keep going. But I could definitely see people saying, you know what, take the house. Like, this is a lot. This is a lot on anyone. They're in an emotional, stressful situation. They, losing the house itself has its own level of stress. And so, when you ask them to do all these other elements, in some of our rural areas, I mean, good luck finding a UPS store anywhere nearby. So you as the housing authority might be doing just that, supporting them in every way to keep to keep this process going. Ensure borrowers have resolved the hardship, right? So that's part of it. Maybe that you've got a new job. It's making you can show proof of income, and so in that way they know they're not going to be back down this road with you in a month. So the first month missed payment, your lender will contact. So this is the timeline. This is giving you an idea of exactly how it works. And I took it directly from HUD's guidance. So this is something that the banks know. This is the process it should look like. And if it doesn't, there's numbers to call to report that it's not being done in this way. So the first month missed payment, your lender will contact you by letter, and more often letter and phone and email. I mean, they really do their due diligence there. Second month miss, your lender is going to start calling you to discuss why you haven't made your payment and maybe provide you with some options. It's important that they're taking these phone calls. Talk to the lender, explain the situation. Maybe you still have time to be able to come up with some sort of plan. Once you fall past that 3-month mark, then in the third month of with the missed payment, you get what's called a delinquency letter stating the amount, and then of course requiring you to make those payments plus fees associated with that. Typically, those are just late fees at that point. But you also get this demand letter or notice to accelerate. And what this means is it's like, okay, you're not in fulfillment of the mortgage or the agreed upon terms, and now we're going to have to move forward with some sort of foreclosure proceeding. I didn't say this before, but I have said it in past classes. Banks do not want to foreclose. It's time consuming. It's costly. You got attorney fees, you got county fees, recording fees, you got all these other fees that they've got to pay now to recoup these funds. Even if they do an insurance claim to recoup some of these funds, it's costing them money, time, and energy that they'd much rather spend on getting you back on track. So, there's no other way to say that. And clients don't know that. You don't know what you don't know. And so it's really important that we're letting folks know nobody wants to take your home. Once they know the motive, the heart behind what most of these banks want to do, they'll work with them to figure out a way out. But that people have to be willing to be on the other end of that phone call. 4th month missed. Now you're nearing the end of time that the demand letter has allowed. And so you'll incur both attorney fees as a part of your delinquency and required to do whatever is necessary. They may ask for the payment in full. So there are no options except to pay exactly what you owe. So once you're in that stage, the sheriff's office, if you're off reservation, the sheriff's office, public trustee of sale, whoever is within the county handles the foreclosure proceedings will do so. They'll schedule the sale, and that's the actual day of foreclosure. But you'll be notified of the date. Typically it'll be put on the actual door. In some states, it can be as quick as 2 to 3 months. In other states, it may take a year. It just depends kind of on your area. There is such a thing called cash for keys, where you're typically just saying, okay, here are the keys. You're relinquishing, your rights to the home. And so that way there's no like them having to post anything or throw your stuff out, that kind of thing. So when it's on tribal trust land, it is different. And I'll explain that here in a minute. There is a redemption period. That is not different. So you as the homeowner still have an option after the sale date. You may enter into a redemption period. So even after they schedule that date, if you can come up with the funds to pay what is owed, then the bank will do that. As I said before, the banks, they got hit with not just regulations, but with consciousness when it comes to, the lack of humanity that existed in 2008, in my opinion. And so most banks just, there were a lot of folks that said they didn't get the notice of sale, that they didn't know that their home was being up for sale. I was very lucky. I didn't have any of those situations happen to me, but I do know that most banks, even after they've set that date, you're in the redemption period, you're able to save your home. So perfect timing, Linda. If you're on tribal trust land, even though the home itself and the right to use the home site might be will be lost, meaning lost to the borrower, tribal trust land will never lose its trust status, which is how that works. So when you're in the pre-foreclosure process, the tribe will be notified. Oftentimes the tribes get involved and they will pay the amount that's past due. They will take ownership of the home or of the site lease. They may, provide that option to family members and friends to assume that mortgage. Different tribes, will make a decision based off whatever their policies and procedures are in terms of their real estate office or their land management office. So it just kind of depends on which version you have within your community. But as far as the status of the land itself, even though the home and the right to use the home will no longer be available to the borrower, the tribal trust land itself will never lose its trust status. That is not true of allotments. So I kind of have to explain that. Unfortunately, since it's not true of allotments, this is how this works. An active foreclosure or individual allotted trust property could result in the loss of the land, because unlike tribal trust land, an allotted trust is a part of the trust. The land itself is a part of it's considered collateral, right? And so in that case, the property could be conveyed. Remember, with tribal trust, you're looking at land leases, whereas with allotted land, it's being conveyed as land and rather than a lease. So it could revert back to an individual and not be part of the transaction. Now, because of that, the BIA does allow for a trustee for allotted lands, and they take the extra precaution, but it is something to note. And I personally haven't had a situation on on allotted land, but according to the Tribal Leadership Handbook on foreclosure, specifically as it relates to allotted land, that's how it was worded. So the main thing when you're in this process is to stay organized. You will get frustrated telling your story, but you'll also have to provide the receipts, the documentation. So we're talking copies of the loan documents, payment information, name and of the mortgage lender, servicer to whom you make your mortgage payments, a brief explanation of your present circumstances and why you need help. I hate to say it like this, but they need an elevator pitch because no one's got the time to hear every specific reason they're in foreclosure, but they do need to have a succinct explanation as to how they got here and how they want to get out. I think that's the best way to describe what should happen when you're in that place and space. With the last couple minutes I have left, also listing your monthly income and expenses. So communicating with the lender is key. Most lenders will try to keep you in your home when you're in a hardship experience, but you got to communicate with your lender. The prepayment plan, not the prepayment plan, but the payment plan option is what works best. Forbearance is an option when you're in that pre-foreclosure process. The loan modification, this is different. A loan modification isn't a refinance, but it is a modification to your existing loan terms. So, for example, they may say you owe $10,000 in arrears. This is what you owe the bank. They may take that, tack it onto the back end of your mortgage, adjust your amortization schedule, right? All big words to mean, however you planned on paying them, they're going to adjust it so that that $10,000 gets put to the back end of the mortgage. You now start fresh. You might have to pay a certain amount, maybe $2,500 to start it, but at least like this, we can start anew, start fresh. This loan modification process takes time, and you have to agree to it. It's like signing it. It's actually a part of your mortgage documents, and so it'll be added to what you currently have. But it's an option. Loan modifications, as of as a result of 2008, are something that people are familiar with. Within these lender service offices, more so than they'd ever been before. Partial claim. So remember, if you're in a government-backed situation, your insurance, this insurance doesn't protect you, the borrower. It protects the lender who's lending you the money. So a lender, let's take First Tribal Lending, for example, they might do a partial claim on your mortgage for failure to make the payments. And then that way it help you bring the loan current. Now there are fees associated with this as well, but it's an option. Depending on how much you owe, that's the case. Going back to HAF funds, housing affordability funds, a lot of tribes use that money to help folks with foreclosure because it was an eligible activity. But these programs also include options for modification, forbearance, and principal reduction. So it just depends. Each payment assistance program that's out there is a little different. If you still have HAF funds and you're using it towards foreclosure, it's still an option as far as an eligible activity. Consider giving up the home, as I mentioned before. If you consider giving up the home, then you're doing so of your own free will. And when you do that, you might avoid the hits that get taken every first when you don't make those payments as far as your credit is concerned. They can always do what's called a short sale, a pre-foreclosure sale or a short sale. Those are fancy terms. All it means is that they're going to sell the home for less than it's worth, right? So let's say you owe $250,000, but the bank will take 200, or they'll take 150. They'll take whatever the amount is in terms of the market, whatever's going on right now. That's what they'll do. Right now, the home values are higher than they have been in the past. So the bank may recoup just as much as you owe. So that's good. But in some cases, they're recouping less than you owe, in which case, when that happens, you may still owe the difference. If there's extra money made during the sale, you might even be able to keep it. That's totally dependent on the bank. Deed in lieu means that you're transferring the ownership rights to another individual. And so and not another, excuse me, not another individual, but to the bank itself. This is the cash for keys. As I mentioned before, you're basically saying, here's the house. And then you give it on an off reservation situation, you would tell the bank, okay, well, here's the house, here are the keys, and here's the deed. It now belongs to you. And then they can choose to do with it, whatever they choose. Assumption is another option. I don't know if Section 184 loans are assumable. I'll have to double check on that. But essentially, in a conventional situation, let's say you're off reservation, not using Section 184, but just in a conventional model, and you have a buyer. That buyer, if the lender agrees, the buyer can assume the mortgage, take over the mortgage. Some people like doing that because maybe the interest rates are lower than what they are now. So that's a good thing. But the new buyer must be able to qualify for the mortgage. The new buyer must be willing to assume the existing terms and conditions. So they don't really they're not in a place where they can negotiate the interest rate and the monthly payments. So it's got to be someone who's going to assume the same requirements you had. And then you, as the borrower, still may be held responsible for late payments or default fees associated with the mortgage. So assuming the loan is an option for some. But you want to look out for scams. Fear breeds scams. Just they're out in full force, especially during the pandemic, but even now post-pandemic. Beware of third parties offering mortgage assistance. If you hear stop foreclosure now, we guarantee to stop your foreclosure, keep your home, stay in your home. There's all these like little keywords that they like to use. We can save your home, guaranteed free consultation, but what does this look like? And I'm going to talk about it from personal experience. In 2008, I paid $1,000 to have someone, and then their argument was, oh, well, we can get the banks on the phone, because at that point you really couldn't get anybody to talk to. We can get the banks on the phone, and we'll get you a loan modification. Legit, they took that $1,000. I never heard from them again. I went to the office. It was shuttered. I could see through the little window that like all the files against the wall, which means my personal information was just out there for the taking. Because you do give them quite a bit of information when you want them to support, when you're desperate, right? When you feel like you don't have options, going back to that hopelessness. And they're preying on people. You want to be careful with that. So equity skimming is essentially where the scammer convinces a homeowner to sell their home for less than market value to them, and then they take the equity for themselves. So that's one. Phantom help, that's the one I just mentioned, where they say they promise to help the homeowner avoid foreclosure, and then they never do anything. Lease and buyback. So this is one where a scammer convinces a homeowner to lease their home back to them with the promise of being able to buy it back, and then they can't. And then, of course, phony lenders, people saying that they can assist by refinancing, and then they all they're really trying to do is skim that information. Right now, they've got your social, they've got your name, personal information, enough to go and do bad things. So beware of foreclosure rescue scams. Like I said before, these are the areas you would go to if you see or come across those types of scammers. They should be going to you all as the practitioners to get more guidance. And then bare minimum, you can point them in the right direction, whether that's your native CDFI or other organizations that that support homeowners within your communities. That's where they should be going for this info. And I think now everybody's going to be prepared for next June to be able to give their homeowners so much more for Homeownership Month. So with that, I really do appreciate being here today. It's always a labor of love for me to do this work and to put the information out there. Anything I don't know, we can try to find out together, and I can get that information. So I'm definitely willing to take questions at this point. And with that, here's my contact information as to the trainings that I provide, etc., and then my email address. But how to help your clients is just to stay informed. And so wherever you can, use the additional resources in the PDF to help your clients. Any questions? So going back to, if it's the same process on tribal trust land, it isn't when it's, because the tribal trust status doesn't change, but allotted lands, there is a difference. It could put it in jeopardy in terms of who owns the land, because it's so fragmented, and you've got all those different people, interested. Yeah, they call it interest in the property or interest in the land. So, any other questions? Charmaine, I know you. Awesome. Well, again, I'm here, and if you have any questions, feel free to let me know. Thank you.
Thank you so much, Marie. We so appreciate you. That was an amazing presentation. I'm so sorry. This is my first time facilitating y'all, and I kind of jumped the gun with showing the survey slide. So my apologies, will not happen again. But I do want to encourage everybody to please complete today's survey. It is live right now. I'm sending a link in the chat, and you can also find it in the web links to pod where it says today's survey. It's really helpful for us to get this information. We can let Marie know how amazing she is. We can see what other topics you guys would like to hear about in our webinars. And it's just really helpful to us. So if you could please just take a few minutes to complete that survey. Again, if you click the link in the web links, you can find it there, or I also sent it in the chat. It's that Forms Office link. While I close out this webinar, please feel free to submit any of your other questions or comments for Marie. I can kind of see if you're typing, so I'll slow my roll if anyone's putting one in there. We hope you could join us for our next webinar. It's actually going to happen in July 11th, and it's about executive director training. It'll be presented by Cheryl Cosley. She's the principal of Cheryl A. Cosley and Associates, and registration's free, happening at 2 p.m. Eastern, 1 p.m. Central, 12 p.m. Mountain Time, and 11 a.m. Pacific. Feel free to access this and any of our other recorded webinars online. You can find them on our website at nativelearningcenter.com. We have a Cathedra webinars tab and a recorded webinars section. You could click on any one of the webinars that we've done for the past 18 months. Feel free to view them, share them with your friends and colleagues. And we encourage you to check out our upcoming events as well. We have that on our social media sites such as Facebook, Instagram, Twitter, and LinkedIn. And we even have a podcast titled Hopathinga. You can find that on Simplecast, Google Podcasts, Spotify, and Apple Podcasts. And it looks like Jessica is asking, will you be offering this again anytime soon? I missed most of it. So Jessica, you can access the recording of this webinar at our website. It'll be under the Cathedra Webinars tab, and this recorded webinar will be available in about 48 hours. And that's when we'll get it posted, so you could check it out then, if that works for you. Yeah, absolutely, no problem. That's what we're here for. So once again, I do want to thank all of our participants for joining us today. I hope everybody has an amazing rest of your day, and we want to connect with you guys real soon. Talk to us on social media. Come to another webinar. And we thank you so much for your time.